Well, g'day there, guys. Let's introduce Angeline. Angeline, what is an asset?
I don't know.
What is a liability?
I don't know.
What is a debt?
What?
Debt.
What's debt?
Debt means you owe somebody money. Okay. What does short-term debt mean?
Where's short term?
What does short-term mean? Like, the opposite of long-term. You're not sure? Okay. What does long-term debt mean? Okay. What would a long-term asset be? You're not very good at this video, are you? So it turns out that our 6-year-old Angeline has a problem with the definition of assets, liabilities, and whether they're short-term or long-term. She's 6. I suppose I shouldn't blame her. So basically what we want to do here is we want to try and separate this concept of current and non-current in both assets and liabilities. And the short, very simplistic answer is if it's an asset and it will be either in cash or turned into cash within the next 12 months, then it's considered to be a current asset. So if you just think of like every single asset that you can think of imaginable, say for example, a delivery truck, are you going to sell it within the next 12 months? Well, if your business is to buy and sell trucks, then yes, it would be considered current stock. But for most businesses that use delivery trucks, then no, you're probably not going to sell it within the next 12 months, so it would be considered a non-current asset. Just go down the list of assets, think of everything that you can think of as an asset and say, will I turn this into cash in the next 12 months? Will I liquidate it or will I realize it within the next 12 months? Those things will be current assets. But if you're going to have something that's sitting around longer than 12 months, then that is going to be considered non-current. Now, as you pointed out, there is accounts receivable and accounts payable, and both of those are considered to be current assets or current liabilities retrospectively. And that's basically because we would expect that for most of our trade creditors, so in other words, if we're buying and selling and in the process we offer them, say, 30 days worth of trade terms, they just pay 30 days later, we would expect that they actually pay within the next 12 months. Now, if you keep studying accounting, you will find out that, of course, not everybody pays you. Sometimes people just never pay you back. This is called a bad debt, and it's considered an expense, but it's beyond the scope of what we're talking about right now. At the point of sale, when somebody is offered credit, and usually, within 30 days, you expect that they're going to pay within 30 days. So these people are always considered to be short-term assets if they are people paying you, or short-term liabilities if you're going to pay them. Now, as you've also pointed out in the forums, if you were to borrow money on a more long-term basis, such as if you were to take out a mortgage on your house, or you were to borrow some money in order to buy a factory, or indeed if you were to have a hire purchase for, say, a car, which is essentially a long-term form of finance that's not unlike going to the bank, then this would be considered a non-current asset because, of course, that money of paying back that mortgage is something that might happen over, say, 30 years' time. So, simply put, current just means that you're going to either realize it or pay for it, in terms of assets, you're going to realize it within the next 12 months into cash, or if it's a liability, that you're going to pay it out in the next 12 months. Now, why do we want to split up the difference between current and non-current? Well, it simply boils down to what will kill us first. Like, you might have, say, some massive debt. Let's say that for some bizarre reason, I come to you and I say, well, you're going to owe me $1 million in 25 years' time. Now, for the vast majority of people here who are watching, $1 million is, that's a lot of money, yeah. But the reality is that you could save and invest in property in Australia and earn $1 million in 25 years. Not that hard. I suspect that most of you will be able to earn $1 million in 25 years from watching this video today. However, if I came to you and said, you owe me a bunch of money, you owe me, say, only $10,000, or I'm going to shoot you in the kneecaps and do something awful to you like a gangster, that would actually be quite scary because you might not have $10,000 just lying around in your bank account. You might not have $10,000 just lying around in your wallet. And if you do, Maybe you should put it into the bank account. But anyway, my point is that $10,000 is not $1 million. $10,000 is much, much smaller, but because it's due tomorrow, then it presents a much greater threat to your survival as a human being. And the same thing is true of business. So what we're trying to do when we split up current and non-current is we're trying to say, okay, what parts of these things can be used to solve the other short-term things. So non-current assets are basically things that you use to run your business, but they're not going to be, they can't be converted into cash very quickly. Current assets, such as any stock you've got lying around, any securities, such as shares that you can quickly sell because they're liquid, and indeed, of course, cash, as a good example, are things that you will be able to turn into cash relatively quickly. Now, the most important out of all of these is current liabilities, because they're the short-term debts that you have to pay off. And if you don't meet your short-term debts, then the creditors bring in, basically you go bankrupt and you lose your business. So, yeah, nice knowing you sort of thing. You want to definitely make sure that you've always got enough cash to cover the current liabilities. I hope that clears up the difference between current and non-current. I want to wish you all the very best for your studies. Happy studies, guys.